Okay. So good afternoon, Tom, and let's get started with the discussions for the day, right? And in today's discussion, first of all, we'll start off by creating a list of the key concepts that we had discussed. So, as said, as discussed, today is going to be the last session on stochastic calculus, right? We could complete the overall frameworks, and next week onwards, we would move more towards the market risk concepts. So, Tom, it would be great, if you could kind of be on mute, right? So while I start off with the discussion,
Okay.
so whenever you have queries, you can just unmute yourself. Yeah, thanks, man. Thanks a lot. Okay, so the key concepts, the so key concepts which has been discussed here are the key concepts discussed here are uh, basics of calculus. So we talked about the concepts of functions, limits, continuity, and differentiability. Then basics of optimization. Basics of optimization using calculus. So when I talk about the basics of optimization using calculus, following are the things that I usually refer to. So I talk about maxima and minima, maxima minima, and we talked about the single conditions of single variable optimization. Single variable optimization. That is the first order derivative, second order derivatives. The third over here that we talked about. So after we had brought in these concepts of calculus optimization using calculus, so where we talked after we have talked about the the basics of functional limits, continuity, differentiability, maxima, and minima. The next thing that we started talking about was we introduced the concepts of dynamics, right? So why would or how or when would a dynamic situation or dynamic model be coming into place, right? So how do we assess dynamics and what exactly is the objective of any risk models, right? So basically concepts of dynamic equations. So over here, dynamics of discrete time, which is the concept of difference equations, and the dynamics of continuous time. Continuous time is differential equation. A differential equation, right? So in the next part we talked about introduction to stochastic calculus. So in this part, what did we see? What we did over here was we looked into that how is it that from a difference equation, how is it I can move to a stochastic equation? What is the difference between a simple equation, a simple difference equation, and a dynamic or uh, what should I say, a stochastic difference equation. So that's the next part that we talked about. So we talked about introduction to stochastic calculus over here. We brought in concepts of the Brownian motion. We introduce the concept of Brownian motion, right? So when I talk about the concepts of Brownian motion, so what is it that we are talking about? So concepts of so introduction to stochastic calculus. So this is where the concept of Brownian motion is coming in. Now it is this introduction of the Brownian motion which which changes, or which brings in kind of dynamism to to the no, not to market risk, but to these risks and unforeseen situations. So we introduce the concept of Brownian motion and white noise, right? So over here, when we talked about this Brownian motion and white noise, this is where we brought in the elements of stochasticity over into our analysis, right? Now, Brownian motion is the element, or it's a description of uncertainty in differential models, or in differential or continuous time series models. In continuous time series models. Whereas white noise is in the difference time series models. Right. So these two are the broad concepts of Brownian motion. So this is where these two concepts actually came in. Now, after we introduced the concepts of these stochastic concepts, right, into our discussion, so therefore over here we brought in so to explain this, we introduced the concept of normal distribution of normal distributions. We introduced ourselves the concept of normal distribution. Now, what is the concept of normal distribution over here? So, normal distribution is, so why do we introduce it? We introduce it in order to bring in the cases of a symmetric distribution and to study the aspect, where the symmetricity of the distribution converges to white noise. So this is something which we had looked into last, which we looked up to in the last class, right? Now, in order to understand stochasticity from a more applied perspective, or to have understanding of stochasticity from the point of view of examples, from a more exemplified perspective, we looked into examples of stochasticity, and that is where we introduce the concept of, we tried understanding the example, or we use examples of stochasticity in financial time series. In financial time series, and we brought in the concept of volatility. So, or let me put it like this, we brought in the concept of the asset price volatility. And in the last class, and finally what we tried doing was, we tried explaining the asset price volatility using the Brownian motion and the Black-Scholes-Morton model framework and the Morton model framework. So we used, we had used all these. So we had studied all these parts, right? In the last class, what we saw was execution of the Brownian motion, execution of definition of Brownian motion, description of Brownian motion, using the Weiner process, right? So now, as far as the discussions till the last class was concerned, there were certain open ends to our understanding, which I would like to draw up in a in a string, and I would like to explain that open end first before I move on. So there were certain open ends to discussion, understanding, and our discussion and discussions. Number one, the concept of Weiner process. The second question which came up in the last class was the ways of measuring the Weiner process. Right? Or not, I would not say the process, rather I would say the variable. Why do we need the Weiner process to model stochasticity? Right? So these were the three questions which we had in the last class. And the next part was how is it that we could execute Weiner process in execute the Weiner process in a software pattern. Right. So this is something which we had seen in the last class using Excel execution show. So this was the things that we had covered till now, and finally in the last class these were the open questions, right Tom? So do you think I'm missing out on anything, or would you like to add on anything else?
Actually, that Black-Scholes model you will be covering, right?
Yeah,
Black-Scholes-Morton
yeah,
framework.
yeah, yeah.
Okay, fine.
Yeah, I'll come to the framework later. So when I start talking about the CAPM models and the market efficiency models, and that's where I'll talk about the Black-Scholes model.
Okay, fine.
Yeah, perfect. Okay, so so very quickly we'll just kind of wrap it up. So the point where whatever we were discussing over here, right? So we have two things to understand over here. So let's first try with that asset price movement. So what we are trying to say is that the continuous change in the asset price, right, which is nothing but the return on the asset price, the return of the asset, as we were discussing in the last class, the percentage change in the asset price, the percentage return, right, is determined, or the change in the percentage return is determined by the following factors. One was the mean of the asset. So this is the return series of the asset, right? So mu a dt plus sigma a is the volatility, the average dispersion, the average volatility about the mean. That sigma a dw a over multiple a at time t. So this is what is the dynamics or the price path over a period of time of asset prices. The dynamics of the asset prices. So over here what we are going to see is the the dynamics of the asset price that we have over here, right? Now let's try to think about the movement of the asset prices or the return paths, right? So let's have a look into the graph. So over here, so this is the return axis, and this is the time axis, right? 0, return. There is time and there is return. Okay. So now over here, what you see is, so over here, so this is the long run average value of the asset, right? Now the asset price starts moving about it, right? So over here, let's say the asset price is something like this. So it's something like this, right? So you'll observe that at each point of time, right, when the actual price, so how the actual price moves is determined by the average movement or the average return from the asset, right, which is by this asset price path, right, and by the overall variation in the asset price, which is your sigma A. So that's the point in time or the point volatility of the asset. However, when I'm talking about the dynamics of the price, I just cannot refer to point in time mean and a point in time variance or standard deviation. I need to also talk about the way these would move. Now, the question that comes out over here is that mu A is the return of the asset, right, over a period of time. So that is where the role of this dt comes in. So we know that for substantially large volume of changes, we use the delta. Sufficiently large volume. Hey, hi Tom. Tom, just give me a minute. Huh? I just have a call. Give me a minute. Okay. Hey, hi Tom. Sorry, I just got a call from office. Yeah. So, so as I was saying, so when we represent, when we talk about delta, so we talk about, or we represent it using delta when we talk about a sufficiently large change. sufficiently large change, right? The next part that we have over here is we use this D just to represent the overall, for very small changes. So D is used to represent small changes. Small changes. So over here, when I'm talking about small changes, it means that I'm talking about a variable which is changing continuously over time, and it is this movement of the variable over time which is creating the bigger challenge. So that's where I'm trying to create. So that is where I'm trying to create a framework, right? So that is where. So that is where. So what? Yeah. So when I'm looking into this movement of a variable over a continuous period of time, especially let's say an asset, so there is an asset whose price is fluctuating over a period of time. So the return or the volatility, the sigma, the mu cannot be constant always. However, the long run mean is more or less constant. But when I talk about sigma A or so the variance, especially the variance, the volatility, that cannot be constant. That is random, right? So if that is random, so I need an element along with it to ensure that volatility is not constant but it moves out in a Brownian fashion. So let's say, so over here, so over here you have a kind of a variation, so over here you have another kind of a variation, so over here you have another kind of a variation. So these volatility values, they keep on moving up and down, right? So to create this up and down movement, what I need to create is I need to bring in an element of stochasticity over here, and that element of stochasticity is brought in using this Weiner variable or this Weiner process or this Weiner variable. So now the question is, why Weiner variable? What is this Weiner variable? What is this Weiner process? Right? So this is what we need to explore. This is what we need to understand over here. Right? So what is this Weiner process? Right? So how do we create this Weiner process over here? Or how is this variable defined actually? So now if I need to talk about this Weiner process over here, this Weiner variable, so let's try to understand this first. How is this? The first question that would come out to me regarding this is that how is this defined? So how is this done or how is this defined? So that's the most important part because the way it is defined now, W for us is just a symbolization. But the question that comes out is how is the element of randomness or stochasticity, kind of defined or introduced through this variable? What is this variable? So the Weiner variable, very simply, as we had discussed in the last class also, is a variable which is normally distributed with mean 0, A. follows normal distribution mean 0, right, and a variance of t minus s, right? So this is how it is defined. So now what I say is that yes, this variable is random. But the next question that comes out over here is that how is it? Why is it that this specification is random? Why random? Because this variable is defined in such a way or is defined with such properties that it is random in nature. So why random? So now the question is that why random? Now to explain the randomness, that why is this variable called a random variable, or how is it that randomness is associated with this variable? The next thing that we do is the next thing that we do over here is the following. We explore the properties associated with this. This so basically the question that comes out over here is the properties. Okay, so we need to put out the properties over here. We need to understand that how is this being created. So what are the properties of this process, right? Okay, Tom, just give me a second. I'll just be back. Give me a second.
All right.
Yeah. So over here, what we have is the first property that this process has, or the way this process is defined is the first property that we need to understand for this variable is that this is w0 is equal to 0. So that means if you time 0, if you have this variable, so this variable will give you the value 0, right? So at initial point it is 0. So it's something like this. Let's say I'm standing at a time 0. So over here, let's say I'm standing at time 0. This is time t. So not return. So this is Weiner process. Weiner, right? So now what we are saying over here is that at time 0, right, the Weiner variable has the value 0. So that's W0 is 0. So it starts from the origin. That's the first property. Now the next property that it talks about is says that every increment, right, that happens over an interval of time. So let's say every increment which happens over this for an interval of time. And what is the interval of time? Let's say starts from t and it goes on to s. So let's say the system starts from ws and it goes on to t. So t minus s is the total time period. Let's say it starts from 0, right? And this is t, it goes t period. So what is the total increment that has happened over the time? So the total increment that has happened over here is t minus 0, right? So there is t minus 0, right? So over here, what would happen is, so this is the total time interval. So let's say the system had started somewhere from here, right? S. So the total length of the time or total interval of time would have been t minus s. Now the question that comes out is that why is it that I'm considering the difference as t minus s? Because this over here time is changing continuously. So you can take any number of infinite values between t and s, and hence the difference between the two is being considered as the difference, right? Or so it is being considered as the interval of time t. So it says that over an interval of time t, t minus s, right? Now, the so any increment that happens, right? So any increment that happens in this Weiner value from s to t is normally distributed. That is, that increment is totally random. I cannot frame out any specific pattern for that movement. So what I'm saying is that for this change in the line set, this part t minus s, right? T minus s. So any increment that happens, let's say starting from ws, So whatever increments has happened right from WS to WT, all the increments are normally distributed. So all the increments which happens from WS to WT are normally distributed. So it means that if I plot the increments, I cannot get a proper pattern in those increment or in those subsequent increments, right? So increments are randomly distributed. Are randomly distributed, right? So increments are randomly distributed. With not only, so if they're randomly distributed, it means that they follow a normal distribution with mean 0 and variance t minus s, right? So that increments are randomly distributed, so they are normally distributed with a mean 0 and a variance sigma t minus s, right? So is these two properties, is the first two properties clear? Then I link up these two properties.
Okay, fine. It's clear.
Perfect. So now let's imagine, right? So there is a particle, okay, or some variables. Let's take volatility as a variable, or let's say asset price as a variable, and it starts from zero, right? And at price zero, it's zero. Now, what happens is that, so you know that the asset price or the price of the given asset is already zero at the 0th time period, right? And the bank is going to invest in that asset. So, what is the risk, or from where is it that the bank will get the risk or face the risk in that investment? Now, any increase in the price will be pulled up by an excess demand. The question that comes out is then what is creating that excess demand? So if an asset of price 0 is pulled up, or the price of any asset is pulled up, it means that there is no factor which is impacting the price of the asset, or the price of the asset is being impacted not by any fundamental factors. Because if there is nothing to, if there is, if the asset is a free asset, or you're just putting in a free asset and someone is buying it for returns, so it means that the person who has issued that asset at time 0 for a price 0 will be paying the money for no returns, right? So then it is what, that's an asset which will give you a negative returns, right? Or I mean that will give the negative return to that borrower, but still there is something which is pulling that asset price up. So that asset price, and that is precisely what we call euphoria in the stock market. So that is what we precisely call irrational exuberance, or extreme speculation, which is going around in the market. Let's say an idea, right? I say that, okay. So I'll just give an example from a very old example. So it's called the tulip mania. So the tulip mania was a case when when tulip flowers started, stocks of companies were selling tulip flowers. They had shot over like by 300%, right? Now there was something that so there was some idea around the tulip mania, that around the tulip flowers, which instigated many people to go and buy those flowers without understanding the true reality, like so whether it was actually true or not. So it was kind of a market a stigma which had just shot off, and it had totally taken the market by storm, and the price of the asset was increasing at the trace of a bullet. Now, when that happens, right, you know that the movement in the asset prices are absolutely irrational. So you cannot explain it. They're absolutely random in nature. Now, it means what? That let's say at time zero, the asset price is zero, right? Now, when the time moves to the next point, in the next 2 seconds, the asset price shoots up to 100, or let's say it shoots up to 5. Then it shoots up to 50, then it shoots up to 100, suddenly it shoots down to 10, suddenly it shoots up to 5. So you actually cannot find out any dominant pattern in the movement of the asset prices, right? So, so looking into the last price, you cannot form a prediction of the price that you are going to get in the next instant. Now, standing now, the next price that you cannot actually predict, because the next realization of the price will be totally independent of the price that it is now. So this is precisely the case of a random or a Brownian movement. So from where the last part, the last point, you cannot make a prediction about it in the next. Right, standing now, you saw the last realization, you saw the realization now. Based on that, you make the prediction. We generally make the next prediction, the next to next prediction. But for that, you need to have a pattern or a determinism flowing across the time points. In a random system, that is not really possible. So what happens at that point of time is that when you're W0, so at W0 you are 0, at W0 plus epsilon you are some, say, some gamma, then in the next point you are some minus delta. So there is no pattern in the movement, right? And that is what creates the Brownian movement, or that is what creates the randomness in the asset prices, right? So this entire thing. So if you look into the first two properties, right, you would be able to identify the element of randomness in this variable. So the way I have defined the variable, right? So W is a variable with certain properties. So it says that if you have if you have a time interval t minus s, right, the value that the variable takes at t and the value that this variable took at s, these two increments are absolutely independent of each other. So stand by looking at t, you cannot backtrack s. While looking at s, you cannot predict what is going to happen to this variable value at t. So between two increments, no matter how small they are, the two you know the two realizations are identically and independently distributed. That is, they are random in nature. So if they are random, it means what? That standing now, I cannot make a prediction. I cannot say what the value is going to be at time t. Similarly, at standing at time t, if I backtrack, I cannot reach that value at s, because these two realizations are absolutely independent of each other, right? So given that the value starts at 0 and it moves and over successive increments, the two realizations of this variable W are independent of each other. Each of the increments are independent of each other, right? And that these increments are normally distributed in the mean 0, right? Means that any increments, positive and negative, they all cancel out, and the mean is essentially 0. These three things together tell you that yes, the movement that this W makes is absolutely random. And that is why the changes in these W's are so they bring in stochasticity to the movement. Now this sigma A which was there was the volatility, it was the average volatility. But volatility is never a straight line, right? So it's an up and down movement, right? That's why it's called volatility. To bring that movement, this DWAT is incorporated over here. So it shows the increments in the Weiner variable of the asset A at time t. So what I'm trying to say over here is that this sigma A and this DWAT, introducing this WAT into that equation, brings in that element of stochasticity, that the asset price The volatility sometimes high, sometimes it's low, again it's high, again it's low. So that element of stochasticity is brought in using this Weiner process, right? And you can do that using the Weiner process because the Weiner variable satisfies these particular properties, right?
Yes, that's right.
Great, fine. Okay, so the next thing about this Weiner variable is that, you know, so say there are two disjoint time intervals, right? One is T1 and T2. Let's say this is a time interval, right? And I have another disjoint time, and I have a time interval which is T3 and T4, and these are all ordered, right? So T1 comes first, then comes T2, T3, and then T4. So if I graphically, if I try to plot it on a line, right? Let's say I want to plot this on a line. T1, T2, T3, T4. Now T2 and T3 can be the same time frame, right? So let's say that this is T1 and T2. So this is the time frame T1 and T2, right? And the second is this joint time interval T3. Okay. So T1 and T2, T3 and T4. So it's like that, right? So the next part that comes in over here is, so these are two elements, right? Now, what it says is that this increment that you get to see over here, which is WT2 minus WT1 and the WT3 minus WT4, right? So these are the two increments into disjoint intervals, right? So this is your I1, this is your I2. Now you know that in I1, WT1 and WT2, these two increments are normally distributed. So within those two intervals, whatever increments happen, they are independently distributed, independently identically distributed, that is, they are random. On the other hand, within I2, the same results happen. Now, what question that comes out is, what would happen if these two joint intervals are taken together, right? So if these two joint intervals are taken together, then how is this thing happening over here, right? So in this case, what we can say is that yes, if these joint intervals are taken, even then what we see is that these two increments, increment I1 and I2, are independent of each other, right? So not only within a given interval, but across two intervals, whatever increments you get in one, increment that you get in the other intervals are absolutely independent of each other, right? So from here, we can clearly see that this Weiner variable, the way it has been defined, are is a random variable. So the increments that happen across them are absolutely random in nature, right? And this property is hold because the time period that we are considering over here is absolutely continuous in nature. Had it not been continuous, then the challenge would have happened, right? Because if it was continuous, right? And so basically, so if it was discrete in nature, then these small intervals of time could not have been created, and hence this definition of WAT or the Weiner variable would not have been possible. Therefore, to introduce stochasticity into a continuous time series, this is the approach which is used, right?
All right.
Good. So the next question that now comes in here is two things. First is uh, that how do I solve this, or after so if I solve this, like what would be the price, or how do I get the price of the asset and so on. That's one. And the second question is that so from this percentage change, so how from this dynamics, how do I get to the price equation, to the locus of the prices, right? That's one. The second question that comes out over here is that from here, how do I get to create that equation? So how do I get to, to introduce risk into this equation? So these are the next two questions that we will be addressing, and with that, kind of we will be closing our discussions on stochastic calculus. Right after this, the so we'll move on to the next part. So so let's try to understand this particular portion over here. That when I'm talking about this particular equation of this particular part, right? The question that comes out is that if I have to introduce, right? If I have to introduce a shock, or if I have to introduce a risk into this equation, or if I have to find out the probability of a risk in this equation, how do I do that? So first of all, what I need to do is I need to define the risk over here, the concept of a risk in the asset price dynamics. So first of all, I need to define a risk. Right? So we'll go to a more concrete definition of the risk later down when we are talking about it. But as of now, we'll take a very simple definition of a risk over here. Right? So let's say the risk that I'm talking about over here is simply a crash, right? So it's a crash in the asset price. Now, if I can predict the probability of that crash, or if I have a idea about the probability of a crash happening in the next 12 months, right? So in the next T plus DT period, right? Then I can plan my investments accordingly. So this is where the concept of a risk would come in. So let's say it is, so there is a probability, I want to identify probability of a crash. So if the asset prices crash, that is where, the challenge, or that is where the risk in the investment will come in. So as a, let's say I'm a bank, right, and I want to invest into an asset. So I want to understand not only what the returns of the asset is, what the riskiness of the asset is, but also I want to assess the chances of that asset price to crash. So that return dynamics to change its trajectory. So it very well might be a situation like this. And in the world of finance, thing, the equations of these types or things like these have often been seen where your return dynamics just suddenly crashes and it goes down. So when I talk about this particular crash over here, right? So my idea over here is that how is this crash done or how is it handled? So let's see that part from here. So first of all, I need to incorporate a crash into this or a risk into this discrete into this equation because this gives me the normal trajectory of the asset price of the returns of the assets, right? So obviously, as one element of riskiness is the spread, right? Let's say I am looking into, so basically, let's say there are two assets, right? And I say that, okay, I want to identify a more risky asset. The question that comes out is that how do you do that, right? To have an understanding of that, let's quickly look through that how that can be identified, right? So it's a very simple exercise. Let's say this is let's say I have normalized the two asset price returns over here, right? So what I've done is, so over here what we have is, we have 0, right? Now, the next point that happens, that comes up over here is this, right? So this is what a similar, a return distribution looks like, right? Now, over here, let's say the return distribution. So the return over here is this part. Let's say this is the mean of the distribution, right? Now there is another distribution which comes up from here. So this is another distribution that I have created over here. So now when I have created these two parts together, how does it look like? Now, how do I compare these two equations? So how do I compare this A and B? So which according to me is a better asset? So this is A and this is B, right? So over here, what one thing that we can see is that the mean returns from A is equal to the mean returns from B. But the volatility of the asset or the the dispersion of the returns for A is much greater than that of B. So the returns in B are more concentrated, right? So it's the spread in B is much lower than the spread in A. So what we can clearly say is that the volatility of asset A is less than equal to the volatility, sorry, A is greater than the volatility, right? So over here, obviously, B is a less risky asset. B is a less risky asset than A, so B is a less risky asset than A, right? Okay. So now obviously one thing that we can clearly see is that the factors which create, where the volatility of the returns are higher, so that makes it a more riskier asset. Now it is generally seen that after asset prices undergo a crash, the volatility tends to increase, and obviously as we go forward, we'll be talking about volatility clustering, right? We'll be talking about the detailed mathematics behind the detailed reasons behind volatility clustering. But over here, we'll just talk a bit about volatility, right? So when we talk about volatility clustering, what happens is low periods of volatility are followed by low periods of volatility. But after a crash happens, right, like going forward, say a crash happens, then it suddenly increases the overall volatility of the asset, and there onwards, a higher period of volatilities are followed by higher periods of even higher periods of asset price volatility. So these two assets that happen over here are very, or these two type of volatility clustering that we have are, so basically periods of following a market crash or an asset price crash, that is followed by a period of higher volatility. Now when we have these kind of things going around, right, so that's where, so the risk comes in the form of a sudden slide in the asset price, a creation of a panic triggers in the market, and this creates a downward, a kind of a direct spiral downwards, which pushes the asset price further down and thereby makes it more and more volatile, right? There have been multiple such instances over a period of time. So the question that comes out is that how do I incorporate this risk into the asset price, into this kind of a dynamics? How do I measure that risk? And next, how do I estimate that? And finally, how do I implement that risk and design my management strategy around that? So whenever in market risk, as we are moving into market, so as we move into the depth of market risk, we'll see that we will be answering these questions very frequently, right? Number one is, how is it that the risk is measured or quantified? Second, how can that be modeled? And how is it that a kind of a strategy of risk management is designed around that, right? So that's the next question that we'll try talking about. So we'll not be talking the risk management side over here in this discussion. We'll be mostly looking into how is it that this risk is created and how is it captured, or how is it that it can be quantified, right? So that's the next part of our discussion. So any questions up to this point?
No, no, Tanmay.
Okay,
That is
thanks.
fine now.
Thanks
But
for
next you would be adding how to introduce this risk
the
into
risk.
the asset
Correct.
price, right?
Correct. The asset price
Okay,
inputs,
okay.
how is the risk introduced, right? So before this, I'll just take a 5-10 minute break and then let's get started, right?
Okay, fine.
Sure.
All right.
Okay. So as you are talking about it, right? Let's say now what I want to do is I want to kind of introduce. So we'll start about talking. We'll start talking about introducing the riskiness into the asset price equation. Let's say this is something like dp by p is equal to mu a sigma a dwat. dwat, right? So this is what we had till now, which was the normal. This was precisely how the equation was. Right? Now to this, what I write is k dj. Now this dj is nothing but a change dummy, k dj. So now, how does this incorporation into this equation cause an increase in the market risk, or how does this bring in the asset, or kind of bring in a change in the market, in introduce risk into the price of the asset? So over here, what we do is so the first question that comes out is how is DJ explained? So DJ is nothing but DJ equals to 1 if if the crash occurs. If the crash occurs is equal to 0 otherwise. Is equal to 0 otherwise. So this dummy that I have introduced over here, this dummy is called the crash dummy, because this crash, or this will give me an idea as to whether a crash has happened or not. So this is precisely the crash dummy. So this is precisely the crash dummy that we have here, right? So now, how do I interpret this statement? What I say is that if the crash occurs, let's say there is a crash, right? The asset price or the change in the price, or the rate at which the prices are changing, or the dynamics, it goes a sudden shock, right? And there is a sudden fall or a discrete fall of k units. So on the event of the crash, so on the event of the crash, on the event of the crash, right? There is a sudden fall in the amplitude by k units. So there is a sudden fall in the amplitude by k units. In amplitude. Now this sudden fall is nothing but it's a discrete fall that we have. Right? So on the event of the crash, so there is a sudden fall in the amplitude. Right? So over here what we get to see is the new A. So basically, the increase is, or the risk is introduced through the movement. Okay, so as I was saying over here, so over here, as we see that, so over here, what happens is that on the event of the crash, there is a sudden fall in the amplitude, and this K that I have over here shows the amount of loss, or the sudden fall that happens in the asset prices, right? So if you have a look into this, so you'll see that the returns of the asset undergoes a sudden structural change. That because of certain events which has happened, right, the returns have suddenly fallen down. And once the return has fallen down suddenly, right, the next thing that has happened over here is that the return, because the asset has fallen down, so the demand of the asset suddenly falls, and then a downward spiral begins, and many of the people who had actually invested in the asset loses their value, and hence a lot of loss, financial loss, is actually occurred. I mean, actually incurs. So this is zero. This is the time, right? And over here, what we have is the returns, or the asset price movements. Let's put it as the asset price or returns. Asset returns. So how does the asset price looks like before, or I mean, how does the trajectory looks like before the part actually occurs? So what happens over here is, it goes something like this. suddenly you have a discrete fall, right? And then it begins off like this. So this is the fall by k units. Now over here I'm hard coding the k. In more advanced models we can obviously find out a distribution from where that k can be extracted, right? So this k is the fall or the loss of amplitude. So this is called the shock parameter. Called the shock parameter, right? So now, after we have seen this, the question that comes up, so there are two questions that come up. So the first is, that if the shock happens over here, right, you see that this value falls, right, and then we have a thing over here, right? So there is a, so what I have over here is a shock parameter, right? So the question that comes out is that how is it that this can be predicted? So the entire question of risk management would be or would be involved in predicting this k, the chances of this k to occur in the next dt period, right? Assuming that it has still not happened at the tth time point. So over here, if you have a look, right? So this k. So what exactly is the question of the risk management which comes up? So it says that at time t, at t, right? Assuming that if the shock has not occurred, t, if the shock has not occurred, the shock has, if the crash has not occurred, not occurred, what is the probability? What is the probability of k to occur in the next dt period, right? Assuming that k has not occurred. Assuming that, what is the probability that crash will occur in the next t plus dt period? In the next dt time period plus dt period, in the next forward looking time window, assuming that it has not occurred. So the entire problem reduces in estimating this rate, and this probability is called the crash hazard rate. So our objective is to estimate this crash hazard rate. And the question that comes out is that, now how do we know that which is a crash hazard rate, right? So now the question that comes out is that how is it that this rate can be predicted? Or so predicting this rate is the biggest challenge. Or this is the heart of the risk management strategy. So that is what is the crash hazard rate, right? And the entire problem, and so the risk management strategy would be, or the prediction or the modeling part would involve estimating this rate. Estimating this rate. Let's call this hazard rate as HT. And since it happens over a period of time, is HT dt. So this HT is nothing but your crash hazard rate. So now if I can actually identify those factors, if I can identify those factors which will help me estimate or which will help me identify this crash hazard rate, that is the core. So that would be my model. So what are the factors which impacts the crash hazard rate? And if I know those dynamics, I can obviously estimate my HTDT, right? Now, when I say this, right, so there are a few important chances that we can also look into. So the first point is that what do you think, or what exactly is this uh, crashes at rate, or like, see, if I want to estimate this, right? So the question that comes out is that how do we do this, or how do we estimate this value, right? So let's try to understand that. Right? Now, before we go to this, like, so we have been talking about HT and we have been trying to talk about these values. Now, when we are trying to predict, right? So now so the question over here, now it boils down to the fact that if I have to kind of model my market risk, if I have to model the risk in the asset price, I need, standing today, when I see an asset price trajectory in the asset price time series, I should try to understand that then what should be that predictive model which will help me assess the risk associated with that asset, right? And to do that, I need to predict the crash hazard rate. So standing today, I need to fetch in the probability that the asset price will be crashing in the next 3 months, like in the next T plus DT period, right? So that is something that I need to do. Now, if I'm trying to do that, right, the question is how do I predict? And what are the concepts that I need to understand to do that prediction, right? So the next part, this is where the predictive part of market risk models would come in, right? So the question that next comes in is that how do I predict? What are the possibilities, or what are the techniques of predictions? That is what is predictive. So what is this predictive models? What are predictive models all about? Now, if I'm to talk about predictive models, right, or if I'm to model something predictively, that's where the question that comes out is what are you actually predicting? So in any predictive models, when we are trying to predict anything, we are trying to predict an average forward looking behavior. So we are trying to look into an average tendency. We are looking into an average tendency of the variable of a variable in a forward-looking time period. In a forward-looking time period. In a forward-looking time period. So it's an average tendency of a variable in a forward-looking time period, right? So over here, when I'm doing this, when I'm trying to predict an average behavior of a variable over a given time period, right? Simultaneously, what I'm also trying to do is, trying to do is, I'm trying to make this prediction conditioned on the past information. Trying to make this conditioned on the past. So conditioned on the past, right? So the next thing that if I'm trying to do this, if I'm trying to predict this, the next question is that how do I represent the average behaviors in a stochastic framework? So how do I model these average tendencies? How is average behavior represented in a stochastic model or in a stochastic environment? How is an average behavior done or replied? So how is average behavior represented in a stochastic environment? So these are the next set of questions that we need to address. Number one, how is this average behavior represented in a stochastic environment? Number two, how is this probability predicted? Number three, how would a risk management strategy be designed around this to manage this risk? So once we have an idea, an overall idea, then the core modeling and the core quant side can be really focused on, right? So let's stop here for the day, Tom. Let Umesh also join in. He is not well today. So once he joins in tomorrow, the next class, we'll complete this part and we'll move to our core to the market risk area. Thank you. And
Okay.
just check whether
One
you
more
can
thing.
access all the recordings. I'll be uploading the remaining ones, and then you can have a complete look at it.
Can you just open those recording from your side? Actually, when I'm clicking on